Hi everyone. In the previous Chapter 12 review video, we worked some problems relating to an equity investment using the equity method. In this video, we'll modify the Adams Industries example and work some problems using the equity method to account for an investment when the amount paid for the investment is greater than the book value of the identifiable net assets of the investee. On 11X1, Adams Industries paid $9 million for 100,000 shares of Sparks Company common stock. The book value of the acquired shares was $8,750,000. The excess of the price paid over the book value is attributable to manufacturing equipment that is being depreciated using the straight line method. The equipment has a remaining useful life of 10 years. During X1, Sparks paid dividends of $1 per share on the 400,000 shares of common stock outstanding throughout the year. The market value of Sparks stock was $95 per share and on 12/31/X1. Sparks reported net income of $870,000 for the year ended X1. How much unrealized gains or loss will Adams record for this investment at 12/31/X1? As explained in the previous video, Adams purchased 25% of Sparks common stock, so significant influence is assumed, and Adams will use the equity method to account for this investment. No unrealized gains or losses are recorded under the equity method. At what amount will Adams report this investment on its balance sheet at 12/31/X1? Adams will report this investment on its balance sheet at 12/31/X1 at a value of $9,092,500, calculated as cost of $9 million plus 25% of Sparks' net income less 25% of Sparks' dividends less depreciation on the equipment. $9 million paid for the investment, less $8,750,000 book value for the identifiable net assets, equals $250,000 of value, fair value on the equipment over its book value. Divide that by 10 years for a reduction in the investment of $25,000. How much revenue will Adams recognize in 20X1 from this investment? $870,000 of net income reported by the investee for the year times the 25% ownership equals $217,500 less the $25,000 of depreciation expense on the equipment equals $192,500 that Adams will recognize as investment income for the year ended 12/31/X1. Well, that's all for this video, and that's all for the review exercises for Chapter 12. I'll see you next time for review exercises in Chapter 13.